March Madness. It's one of the greatest sporting events that's out there. We've already seen some wild swings of emotion, some buzzer beaters, obviously a lot of excitement. And most of us, just for fun or for money, fill out a bracket only to see it busted by the second day. And what I've seen as an advisor is that some people treat investing the same way as filling out a bracket. And it often comes with some of those same wild swings of emotions. So let's take a look at some of the ways that maybe we can protect ourselves from all of these emotions. Let's talk about the bracket emotions themselves. How do we react when our bracket is busted? Oh, I wasn't going to do it. I don't know why I do this to myself. I'm never doing this again. Well, how about when our bracket is perfect? Ooh, I knew it. I called it. I'm so good at this. This is easy. You sound familiar? The same emotions show up in investing. When markets are down, panic takes over. When markets are up, feel pretty good about ourselves, where confidence can creep in. This is behavioral finance in action. And some of the common patterns that I see happen in both directions. Panic selling, selling when fear peaks. Overconfidence bias, thinking that recent success is skill and not luck. Recency bias, assuming that what's happening now will keep happening, whether that be good or bad. Hot hand fallacy, believing a streak will continue simply just because it has. These behaviors can lead to really bad investing choices, both when winning and losing. Let me tell you a quick story, and that's the story of Bobby. Bobby came to see me a couple years ago. He thought he was anywhere from 6 months to a max of 2 years away from retirement. So I said, all right, let's do a financial plan. Let's confirm all of this and give me all your data, your outside assets. And so when I started gathering that, I noticed that Bobby had 100% of his 401k sitting in cash. So I called him up and said, hey, Bobby, do you realize this? Did you do this on purpose? Was this? He said, oh, yeah, I did that back in 2022. I said, 2022? Why'd you do that? Well, I was scared of the market. I said, okay, why didn't you get back in? I was scared of the market. Mistake number one, he sold when the market was down. The market was bad in 22. Mistake number two, he never got back in. He missed 23 returns, 24 returns, and 25 returns. They were all positive and really good. Even larger mistake, he missed time for his retirement. Because of those two decisions, getting out and not getting back in, he cost himself, instead of retiring in 2 years, we had to back up and had a hard conversation about retiring in 5. And so the takeaway here is that if you let your emotions run your investment strategy, they will impact your long-term success rate. What Bobby wanted to and was trying to do is completely avoid risk when it comes to investing. But you can't really avoid it. You just mitigate it. And so the goal is to try to put the odds in your favor and not hope for a perfect bracket. And so taking that to investing, what that really means is avoiding the temptation to pick a single stock to win it all. Instead, we could look to pooled investments like ETFs or mutual funds to spread your risk. Because if one stock loses, it doesn't derail your plan. And you're more likely to achieve consistent long-term growth. And if you've noticed by watching some March Madness commercials, you may have seen an ad for an ETF called QQQ. This isn't a coincidence. These investments involve market risk and may decline in value, but they are intended to provide a diversified market exposure rather than a concentrated risk in a single company. Just like in March Madness, where we can't predict every winner or every upset, in investing, we can't control every outcome. But by diversifying and thinking probabilistically, we can tilt the odds in our favor. So this March Madness, enjoy the excitement. And remember, winning consistently in investing isn't about picking a single winner. It's about playing the long game, spreading your risk, making the odds work for you. Next week, we'll be a day or two away from wrapping up the first quarter of the year. Can't believe it. So I want to do a quick recap of what we've covered so far on the groundwork, what we have to look forward to, and just a couple things that I've been seeing in the field with clients. Looking forward to seeing you there.